Welcome back to the Global Ledger. I'm Justin. In episode 4, we cleared the air on one of the most biggest misunderstandings in finance, and that was the Fed, does it print money? So today, we're following that thread all the way to the real creator of everyday money, the banking system. And to make it as concrete as possible, we're going to walk through exactly what happens when you get a mortgage, step by step, line by line, and balance sheet by balance sheet. So by the end of this episode, you'll understand who creates money, where it comes from, how banks actually lend, how deposits are born, and why almost everything people believe about lending out deposits or reserves is completely backwards. So let's dive in. So where to begin the story? Let's say you're buying a house for, call it $400,000. Okay. You walk into the bank, you hand over your income documents. They go through your credit history. They tell you you're approved. Now, here's the key moment. Most people think the bank does something like this. Let's check how many deposits we have so we can lend Justin the money. But in reality, that never happens. The bank does not look into a vault. The bank does not check deposits first. The bank does not transfer money from savers to borrowers. Instead, the bank asks one question. If we issue this loan, can we manage the balance sheet? And a couple others to follow up on that would be, do we have the capital? Do we have the ability to fund it? Can we hedge interest rate risk? Will regulators approve of the risk? And another one, let me think. Will the loan be safe enough to hold or sell? So nothing about deposits, nothing about reserves, nothing about lending out savings. So that's the first myth. Gone. So let's get that out of the way. So when the bank approves your mortgage, it creates a brand new asset on its balance sheet. So your loan. This loan is worth $400,000 to the bank. It will generate interest for the next, let's say 15 to 30 years. This is where money creation begins. But remember, a loan alone by itself isn't money. To create money, a bank must create two things simultaneously. An asset, which is the loan, and a liability, which is your deposit. So this brings us to the next step. So once the bank creates the $400,000 loan, it now owes you $400,000. So how does it do that? By creating your deposit account with one keystroke. So no one else's account goes down, no saver loses money, no one transfers anything. The bank simply writes a new promise to you, and that promise that the bank is making you is your money. So this is the core of modern money creation. Loans create deposits. Deposits do not fund loans. So they create an asset. Your promise to pay and a liability, which is their promise to you. So let's go to the settlement aspect of this process now. So now when you go to pay the seller, okay, now you don't actually spend the deposit. Your bank pays the seller's bank. Clearly, if you're working with a title company, that's different. I'm just trying to remove all the other parties, any layers that could make it extra confusing. I just want to kind of leave out of the picture because we all know like a more realistic way this happens. But so just the clean backbone structure. So here's how that works. Your bank reduces your deposit by $400,000. Your bank instructs the Fed to transfer reserves to the seller's bank. The seller's bank receives reserves and increases the seller's deposit. So here is the beautiful part, I should say. Your mortgage created a deposit at the seller's bank and a loan asset at your own bank. So the money didn't come from anywhere. It came from the bank's balance sheet expansion. So this is the heartbeat of money creation. Call it private credit, backed by a real asset, settled through the reserve system and supported by the central bank. So it's all said and done. You have the house, great. Now, what's happening in the back end? So that's what happens to the loan. And I'm going to take this from a shadow banking angle, and this ties in with why there are intermediaries and wholesale lenders like UWM as an example. This is the crux of the matter. So most people think that the bank holds the mortgage for 30 years, and maybe not everybody, but I think folks do have some kind of indication that the bank's not hold, maybe not. I don't know completely, but it may be intuitive and it may not be, depending on which way you think about it. But sometimes they do, but very often they don't. So banks, what they frequently do is they sell the loan to investors or agencies. They swap the interest rate exposure and then securitize it, and then or another thing is pledge it as collateral in wholesale markets. This is where working with a mortgage broker connects directly to this picture. So what does this do? It creates money-like liabilities in the shadow banking system. So mortgage-backed securities, repo loans, collateral chains, dealer funding. So your mortgage becomes part of a global web of funding. So and none of this was possible until the bank made that initial balance sheet move. So issuing the loan that created the deposit. So I guess another point or topic we can bring into the picture is why banks aren't lending out deposits. And at this point, it's worth addressing this misconception, which is a big one. And people say banks lend out deposits, but think about what we just saw. We just talked about. Deposits didn't exist until the loan was made. So it cannot be the case that the bank lent out a deposit from someone else. That deposit was born from the loan. So here's the actual sequence. Bank approves a mortgage. Bank creates a loan asset. Bank creates a deposit liability. Bank settles the payment using reserves. And then was the last one we talked about, new money enters circulation through the seller. So banks don't lend deposits. Banks create the deposits. So what actually limits bank lending? We can talk about this. So if banks can create money at will, why don't they create infinite money? So and I would argue that they face 3, maybe 4, but 3 certain constraints. Number one is capital requirements. They must hold capital against risky assets. The second one would probably be funding and liquidity requirements. They have to meet payments and maintain stable funding. Really important. So number 3, willing borrowers. This is also a constraint. A loan only exists if someone wants it and can repay it. So banks aren't reserve constrained. They're capital and risk constrained. So A bank with no reserves but plenty of capital, well, can lend freely and simply borrow reserves as needed. So, connecting this up with finance valuation. When banks create loans, they expand credit, liquidity, spending, investment, risk-taking capacity. This feeds into earnings, pricing power, asset demand, valuation, building blocks like discount rates, and cash flow expectations. So credit cycles, you could say, in this context, are valuation cycles. And it all begins with that simple moment when a bank says yes to a borrower. So I think that's pretty interesting. You're kind of looking at the life cycle of a promise or an interest to buy a home. What does that look like? I'll add this to the basically the a personal. I can't remember where it was, but I remember being in this ride. I think it might have been at Six Flags. I'm not sure, or the Science Center. One of the two. I know that's different, but I cannot remember where it's at. But it was this machine that allowed you to be a drop of water, and it took you through the life of a drop of water, and it was really cool. And that's kind of how, in my own opinion, I think it's really easy to understand if you just follow the process and follow the pattern in the cycle in which this takes place. You can stop at each point and try to understand it better. And so that's what I'm trying to do here. So back on track here. So I always like to bring this into the why understanding this removes fear, because most people fear the financial system because it looks magical, or another way to say it is it looks manipulated. But once you see the mechanics, how banks actually create money, how deposits are born, how loans become liquidity, how settlement works through reserves, how the Fed supports the system, the mystery really does fade. So, and with clarity, comes calm. So that's the whole mission of this show. So, I want to thank you for listening to episode 5 of the Global Ledger today. Just to recap, we walked through what actually happens when you get a mortgage, and in the process, we uncovered how money is really created in the modern financial system. And next episode, I think you'll enjoy. It's going to tie right into the structure of money and the ecosystem and who sits at the top of the pyramid, or as Perry Maryland would say, the hierarchy of money. Who owes what to whom, why some promises are better than others, and why crises begin when promises fail to settle equally at par. So if you're enjoying the series, share it with a friend and leave a review. It truly helps, and I do appreciate it. So once again, I'm Justin, and thanks for being here.